Welcome, everyone. Thanks for tuning in. I'm your host, Ryan Masad. It's no secret that equity markets around the world have been rattled in the first half of 2022. From conflict in Ukraine to surging inflation to interest rate debates, there have been plenty of uncertainties to keep investors guessing about the state of their portfolios. All of it has created a lot of volatility in the market. Take the S&P TSX Composite Index, for instance. It closed with a gain or loss of at least 1% in about 1 in 4 trading days through the month of May. And for the S&P 500 index, volatility was even more pronounced. It recorded a gain or loss of at least 2% in about 1 in 6 trading days during that same time. This sort of market choppiness may be nerve-wracking for new and experienced investors alike, but there are ways to help navigate volatile times. And here to share some of them is Nugwa Haruna, Senior Client Education Instructor at TD Direct Investing. We're going to discuss the mindset and preparation that can help investors handle market volatility and some trade order tips that they can use to protect their portfolios as they invest through it. Nugwa, thanks for being here.
I'm excited to be here, Ryan, to discuss some of the exciting times and interesting times we're experiencing in the markets today. So let's do it.
Let's do it. First off, what are some of the factors that might contribute to market volatility, like the kind we saw in the first half of 2022?
So there's different factors that could lead to uncertainty in the markets, and sometimes it's quite difficult to pinpoint the exact cause. But what we found is that, it could be due to macroeconomic instability. So this could have something to do with, high inflation and then rising interest rates. You might have events that were not predicted. So you might have situations like conflict in between major global powers. You might have things like a pandemic. So let's reference the year 2020, where we had that pandemic that led to, a global shutdown, which in turn led to huge sell-offs in the market. So there's huge market volatility during that period.
So, how does investing during a volatile market differ from more typical market conditions?
So some features of a volatile market would include things like very heavy trading volumes compared to what you typically see. You might also see a lot of upswings and downswings when it comes to the performances of securities. You might find choppy performances from day to day. And then you're actually going to find more emotionally driven investors during this time frame. Investors may not realize, but during a market volatility, that's when some investors actually do find that emotions do play a huge part into some of their financial decision making. And so this is something to be aware of. And during this time frame, investors could consider using certain other trade types besides some of the most popular, which in this case would be a market order. So one of the things about a market order is that it allows your trade order to be executed right away as long as the markets are open. And that way you can get out of a position really quickly or get into a position really quickly. But one of the things also about a market order then is that because it executes at whatever the prevailing market price is, and you're dealing with volatile markets, it means that you may end up paying a price or receiving a price that far differs from what you originally expected, and you have no control over the amount you end up paying. So during this time frame, investors could consider utilizing some other order types in order to protect their trades during volatile market times.
So, okay, we've established that market volatility is often an emotional time for investors. Given that, what can they do to help navigate market volatility with a cool head?
So one of the things about market volatility is that it's inevitable. And there's a reason why there's, something called the market cycle. You're going to experience dips. You're going to experience recoveries. So for an investor to ensure that they're well prepared to deal with the inevitability of market volatility, it's important they have a solid investment plan. So by having some kind of investment plan, this investor is taking the time to review what their investor profile is, which will include things like analyzing what their risk tolerance is. And in this situation, it could help that investor deal with emotions such as the fear that comes with volatile markets, some of the greed that will tempt investors during volatile markets. It could potentially help that investor make better financial decisions during these volatile times because it could prevent that investor from overcorrecting their portfolio if the underlying reason why they started investing has not changed, if the company fundamentals are still solid. So in that kind of situation, having some kind of investment plan ensures that the investor does what is right for them. It also is important that an investor has a well-diversified portfolio. So having a well-diversified portfolio essentially means that investor doesn't have all their eggs in one basket. So in that case, the investor's portfolio is not being dictated by the performance of one asset. So if the asset performs poorly, it means the investor's potential portfolio would perform poorly as well. So what tends to happen is that different investments respond to market volatility differently. You might have some investments that actually could perform relatively well during volatile times. So by an investor analyzing the different asset classes out there and balancing out their portfolio, it will end up at the end of the day evening out what the performance is for their portfolio because certain asset classes will be better equipped to ride market dips and others better equipped to ride market recoveries. One thing, though, I will point out is, as we mentioned, during market volatility, they could be different factors that have led to that period of market volatility. So if we look back to 2020, during that time, market volatility was caused by, the global pandemic and the lockdown that we experienced. Typically, you would find that when there's a lot of volatility, certain sectors tend to suffer the most. So you would typically have the growth sector that would see a huge decline in the value of stocks there. But we found that because of the cause and during 2020, well, we had a situation where there was now work from home policies. Everybody was working from home. What we saw instead was an outperformance by things like the tech industry as opposed to the general market as a whole. So investors were trying to see what are other investors doing. So if you're trying to take a look at what investor sentiment is, an investor could potentially use a tool like the TD Direct Investing Index. And what that shows you is what investors are buying, what they're selling. So if you look at the TD Direct Investing Index for April 2022, it showed that investors were moving away more from equities and shifting more towards fixed income and cash, which could be due to the rising interest rates we're experiencing right now in the economy. And even within the equity space, investors were shifting more towards energy and shifting away from technology and healthcare. So once again, knowing the factors that have led to the market volatility and uncertainty in the markets are very important.
Well, creating an investment plan and building a diversified portfolio are important to navigating market volatility. And we show you how to do both in our video course, Managing a Portfolio. So check it out in the Learning Center. So sticking to a diversified investment plan is one way to handle market volatility. With that in mind, how might an investor want to think about any market declines they experience?
Okay, so one common approach could be a buy and a dip. So this is essentially where an investor who has an investment plan and potentially has more of a long-term investment approach, they've sat down, they've taken a look at company fundamentals, they've looked at the financial records of the company, and they don't see anything that discourages them from continuing to invest in these kinds of companies. These investors could potentially consider buying that dip in the markets during volatile times. Because essentially what this looks like for that investor is potentially for that investor, they're buying something that could be considered selling at a discount at this time because in the long run, they're looking based on the information they've gleaned from the fundamentals for that stock price to grow in the future. Something else that an investor could practice during this time is the dollar cost averaging. So essentially what this means is an investor has a predetermined amount that they put away frequently, and they use this amount to make purchases for investments. And what this ends up doing is it ends up evening out the prices they end up paying for their investments, almost how diversification evens out the performance of an investor's portfolio. So this may lead to a more disciplined approach when it comes to investing, because you do have a set frequency, a set dollar amount that goes into your investing, as opposed to, infrequent purchases using a lump sum when you're making investing during volatile times.
Some investors might find market volatility difficult to stomach, especially when asset prices are falling, and want to sell off their portfolio entirely until things settle down. How has this strategy performed in the past?
So we may have heard of trying to time the markets, and we may have come across investors who have tried to time the markets. And research has shown that trying to time the markets is unsustainable, because one of the things about the markets is it's unpredictable. So you can't necessarily tell where it's going. There was actually a study by the Bank of America that showed that from the year 1930 until present, if an investor missed out on the 10 best performing days every decade since 1930, they would have had a return of 28%, which in the grand scheme of things is not terrible. But for an investor who actually stayed invested through those 10 days for every decade, their return would have been over 17,000%. I'll give another study that was done by JP Morgan from the year 1990 until the year 2018. And it showed that investors who stayed invested through different market conditions actually had an annual return of about 5.6%, as opposed to investors who missed out on those 10 best performing days once again per decade. They only had a return of about 2%. So once again, it just shows that trying to time the markets means you're sitting on the sidelines. And yes, you may be missing out on downswings, but then you're also potentially missing out on some of those upswings and some of those 10 best performing days in the stock market.
So, keeping calm during market volatility can be tough sometimes, but you can learn more about how to fend off your investing fears in our webinar, Become a More Resilient Investor, which is available in the Learning Center. Okay, Nugwa, we've touched on how to prepare for market volatility, but knowing how to trade during it can be tricky. So let's run through 5 common situations that investors might encounter and how they might place trade orders to help navigate them. To start, we know that volatility can cause a security's price to change very quickly. What can an investor do if they're concerned about overpaying for a stock?
Right. So for an investor who's concerned about potentially overpaying for security, they actually do have different trade orders available to them. And one of those would be something called a limit order. So with a limit order, it actually allows that investor, if they're looking to buy a certain security and they don't want to overpay, it actually lets them set a ceiling or a maximum price that they're willing to pay for that security. And the opposite is the case as well for an investor looking to sell. So for an investor looking to sell, it lets them set a floor or a minimum that they're willing to accept for that security. So once this investor is in WebBroker, they're able to pull up the specific security that they're looking to place this order for. So let's say I'm looking to buy this security, and I put in my quantity of how many of the stock or the security that I want. Once I change my order type to limit, you'll notice now I have an opportunity to actually set a limit price. And in this situation, as I mentioned, as a buyer, I don't want to overpay. So I'm potentially, the best practice would potentially be for me to set my limit price at close to or below the current market price. And so in this instance, I'm going to set my limit price at lower than the current market price. And so what this does then, it means that the maximum I'm willing to pay for the security is my limit price. Now, keep in mind, this also means that my order may not be filled, right? There's no guarantee that my order will be filled. So I might actually have to wait in line for the price to dip enough for my order to go through. So in that situation, I can set up how long I'm willing to wait for my order to go through. And if I, for instance, choose good till cancel, it means I'm willing to wait for the maximum amount allotted or maximum time allowed, which in case of U.S. securities, U.S. traded securities, I'd be waiting in line for about 180 calendar days. If the order doesn't go through, it will be canceled. So an investor whose goal is to set a specific price they're willing to pay for security or receive for security could consider using a limit order as a way to ensure they have control over that. But once again, there's no guarantee that this trade ticket would go through.
So let's hang a bit on that no guarantee. So there's a chance that that limit order may not be filled or only partially filled. Let's say the market is declining very quickly and an investor just wants to exit the position as soon as possible. How can they do that?
Well, so there is another basic order type an investor could use, which is called the market order. So in this case, this investor could utilize a market order, and I'm just going to click on it here. You set up the quantity of the shares you want to sell. The thing about the market order is that the fill is immediate. So the execution is immediate as long as the markets are open. But one of the things about the market order is that you don't have control over whatever price that trade will be executed at. And we're talking about a volatile market. So when you're thinking about a volatile market, they could be a huge swing in market prices. So the investor could end up with an execution price that differs greatly from what they expected. So an investor then in this case could consider using another kind of order type, which is called a stop loss order. So let's say in this instance, I'm an investor, I'm looking to sell this specific security, and I want to protect protect some of my, protect my position. The markets are declining really rapidly. I would click on here and I would go under a stop loss order type, which is called the stop market order. And what this order type allows me do is it lets me set up something called a trigger price. So think of your trigger price as an activation price. And the idea behind this is once this activation price is hit, then my order, which has been dormant in the system, actually becomes a live order. So in this situation, I could set a trigger price at a certain amount, which is the around the amount that, I feel if the markets have such a downswing and hit this certain price, I'm uncomfortable about holding the stock and I need to get rid of it. Then I set my trigger price at this amount. But keep in mind, once again, something about the stop market order in this case is that you're not guaranteed that you're going to get this trigger price. All this trigger price is doing for you is activating a market order for you. So once this price is hit, your order becomes live, goes to the market, becomes a market order. And if you remember the features we just talked about a market order, is that the execution would be immediate if the markets are open, but you have no control at what price the execution goes through at. So some of the best practices when you're dealing with a stop loss order, if you are looking to sell securities during that time frame, you want to set your trigger price at under the current market price. If you're dealing with a stop loss or stop market order where you are buying, you're looking to set your trigger price at higher than the current market price.
Sometimes stocks can move sharply between trading days, especially if there's an aftermarket event that serves as a catalyst. How might an investor protect themselves from these gaps in pricing during volatile market conditions?
Right. So what an investor could potentially do is they could still use some of these stop loss orders that we talked about. So we just talked about a stop market order. And so let's say for an example, I as an investor, a stock was selling for $100. I put in a trigger price of 98. And then overnight, there's maybe unfavorable earnings announcements for this company. And then the next day, the stock starts off trading at $90. So what's going to end up happening to me is I could be stopped out. So this means that once the stock starts trading the next day, my trigger will be activated and I could end up selling my stock at far less than I originally expected. So for an investor who's looking to have some kind of additional level of control, when you're looking to sell during declining markets, that investor could consider using something called a stop limit order. Now, this stop limit order still allows me set a trigger price, which will keep the same. But in this case, it now lets me set a limit price. So if I am an investor who's looking to sell my investment during market declines, but still trying to protect myself against a loss, once I have my trigger price, I could still go ahead and set a limit price. And this limit price would be the minimum amount I'm willing to accept once my order is activated. So the stop limit order, what it lets me do is a sale will be triggered at my trigger price. And as long as the stock price stays at or above my limit price, my trade will go through. Alternatively, if I'm looking to use a stop limit order on the buy side, the opposite would be the case, where my trigger price will be higher than my current market price, and the limit price in turn will be higher than that trigger price. So these are considerations that an investor wants to have if they're looking to still trade during volatile market conditions and not be stopped out of a trade position.
Let's say an investor is concerned that volatility might wipe out the unrealized gains they've made in an investment and they want to pocket some of that profit. How might they do this without selling out the entire position?
Right. So what an investor could consider using is they could consider using some of these stop losses that we just talked about, where the investor, the idea behind the stop losses is to reduce potentially how much loss an investor takes on a position, or to protect any profits the investor has already made. On the other hand, if the investor actually, based on their investment plan, has a specific exit strategy that says, if my investment drops by this percentage, let's say 10%, then I'm looking to exit this position. Well, that investor could potentially go ahead and use another order type, which in this case is called a trailing stop market order. So in this instance, there's still the idea of a trigger and a trigger price, but now we have something called a trigger delta. Because let's say, for instance, that I, as an investor, I anticipate that a stock price will drop. If I set my trigger price, but in the interim, the stock price rises before there's a drop, there's a potential that I've lost out on that, on the corresponding increase before there was a drop in that stock price. So if I want to make sure that I am riding those volatile markets favorably, I could consider using the trailing stop order, because what that does is when there is an increase in the stock price, if I'm looking to sell, my trigger price will also increase depending on the parameters I set. So if, for instance, I use a percentage, so I could say that if the current stock price drops by 10%, then I want my order to be triggered, sent to the markets as a market order. Well, if the stock price then increases, it means that my trigger price will also increase. And that means if there is indeed a decline in the stock price, now my trigger price is a higher number. It means that potentially when my stock goes to the market as a market order, I could potentially end up getting a higher execution price. I could either have a percentage wise decline that I use as an exit strategy, or I could change that to a dollar amount that I use as an exit strategy as an investor, so that I don't walk away not making anything potentially from an investing position.
Okay, so let's say a stock falls, but not quite enough to trigger the stop loss an investor had set. Would it make sense to set a new stop loss at a lower price?
So at the end of the day, the reason why you use your stop loss is to protect yourself against, declines in the market. So if you as an investor, you have an investment plan and you actually created your stop loss, your ticket based off of that investment plan, going back into the system to edit that, is that actually matching up with your investment plan? Once again, this is where you want to make sure that you're not being driven by emotions. We talked about the fear of missing out and the greed and the temptation that comes with the markets. You want to make sure you're sticking to that investment plan. You're sticking to your exit strategy, whatever that exit strategy was. And you want to keep your foot off the pedal in terms of going in there and changing your trade tickets. Consider sticking with whatever the original plan was, as long as there's nothing in the fundamentals of that company that have changed for you.
I guess that investment plan really keeps our emotions in check at that point.
Yes, it does.
So, Nugwa, let's say an investor holds a stock that's already quite volatile and then broader market volatility picks up. They want to either buy low or sell high. What can they do to help ensure they don't miss this opportunity?
Right, so an investor who's potentially looking for some kind of buffer, some kind of protection when they purchase a security can actually use different investing strategies. So there's some conditional order types that an investor could potentially utilize in their portfolio. So in WebBroker, I'm going to click on strategies and one cancels other. So essentially what the one cancels other ticket allows this investor do is, if in a situation where you're having prices going up, that investor could set a limit price if they own that stock, right? About the amount of money they're willing to accept for the stock if the price goes up. On the other hand, if the price of that stock is dropping, that investor could set a stop loss, remember, as a way to catch or protect themselves in any decline in the value of that stock. So, for example, this investor owns this specific security, and let's say they own 100 of this security. So in this case, the investor, if they anticipate that they would be an upswing and they want to participate in that upswing, they could decide to sell the security as we mentioned, when you're using a limit order and you're using it on a sell side, you're setting the limit price at or above the current market price. So we're going to set a price that's above the current market price. And let's say they're willing to wait in line for as long as is allowed. Well, they also are concerned with the swings in the markets, the upswings and downturns, that they may be a drop in that price. So what they could also do alternatively is with that same security, that investor is able to sell the security, we'll put the same quantity. But in this instance, the investor can go ahead and, let's say, use a stop limit and say, if instead of the stock price going up, if it drops instead, and let's say it drops to a certain price, they're looking to sell the stock. And once again, they could use a stop limit and sell the lowest amount they're willing to accept for the stock, and they're willing to wait in line for the same amount of time possible. So what this has done is they've placed two orders, and these two orders are mutually exclusive. It means that if one order goes through, the other one automatically be canceled. And so it means if the prices go up, they're able to sell their stock at potentially higher and make a profit. If prices drop, they're able to protect themselves from additional losses by setting a minimum amount that they're willing to accept for the sale of their stock.
Thanks for helping us get our heads around market volatility, Nugwa. For those in our audience interested in finding out even more about trade order strategies, make sure to watch our video course, Order Entry Essentials for Stocks and ETFs, in the Learning Center. And if you enjoyed this presentation, make sure to register for our upcoming events. Okay, Nugwa, let's keep the conversation going with our audience in our live question and answer period.